coming back with a heater of an earnings report from Walt Disney, baby. Disney reported earnings Thursday after the market closed, and guess what? It opened up around 5% up, right now around 3.7% up. Nothing to be concerned about here. This is a stock that has been, needless to say, on a tear. If we're looking at this past year, let's look at this 5-year chart. I just want to show you something. I mean, this has been a stagnant, I would say stagnant stock. Am I right here? Let's say from 2015 to February, same time, around 8% in about a 5-year period, 4.5 years that is. But lately, the guy's up 27% so far. I mean, year to date, the guy's up 30%. What's going on? It's pretty exciting. So we'll take a look at these earnings, see what we can pinpoint. Non-GAAP EPS beats by 10 cents, $1.07 per share. GAAP EPS of 43 cents per share. Revenue of $19.1 billion, up 33.5% this year. And again, nothing really noteworthy in terms of a beat. $80 million, it's a lot of money, but again, when you have this high of a revenue, $80 million is not quite as much. They don't even show that decimal point, you know. That's pretty exciting, and shares boomed as a result. So my main takeaway, before I get into like the briefing here, is just that revenue aspect, and that's why this stock has blown up so much in this past year. This has been a company that was stagnant for so long. If you're considering this, so from 2016 to 2018, I mean, there's just no revenue growth here. You know, to end of 2018, this is just flat. And you see this initial, I mean, this is a steady growth, and then we just hit a flat period for about 2 years. And then now they've kind of turned it up, and you see this upswing here. And again, it goes even up further from that. So it's pretty exciting. Definitely not a bad thing to see. So I like seeing this growth, and that's really what's happened here. It's turned from kind of a flat business to, again, a growth business, which is pretty interesting. But Disney up 3.8% post-market after easily clearing the Street's profit bar. That's right. Strong gain in TV networks and film studios. Revenues grew 34% year over year. For the fiscal year, revenues were up 17%, to $69.57 billion. Billow, as I like to say. Total SegOp income rose 5%. Oh, I love it. I love when you make money. Net income from continuing operations was $785 million. Making money makes me happy. Revenue by segment. Media networks up 22%. Again, as I mentioned, part of that was due to the Fox acquisition. They had a lot more revenue coming in that way. Parks revenue even. That's right. Parks revenue up 8%. Woo! Studio entertainment up 52%. Direct to consumer and international up 316%, which obviously there's a valid reason for this being Disney Plus. So nothing unexpected there. You should expect that because this is just an entirely new aspect of their business. Broadcast was an unexpected strength in media networks, continuing well ahead schedule of at $2.27 billion. Cash from continuing operations was $1.72. Free cash flow of $409 million. One other noteworthy aspect that came out yesterday: Amazon's Fire TV will carry Disney Plus. Set to launch in 5 days. So that's pretty exciting. Bob Iger disclosed the news on CNBC, added that FX will have a huge presence on Hulu. New streaming platform is ready to go after a quite successful test in the Netherlands. That's what I'm talking about. So more outreach for Disney Plus even. Let's get into some of these numbies. A little bit of the numbies. You know I like talking about these numbies. Revenue, I love looking at the year end, 17% year over year change. You can see this big quarter over quarter change as well. That's fantastic. Income from operations decreased a little bit, and I think you will certainly see a decrease in terms of that actual profit line, and a lot of that's just due to the streaming service. That's kind of just where it is. You spend a lot more on a streaming service, and you can see with Netflix struggling for profitability for so long, it's kind of just an aspect you have to consider. It's a lot heavier spending of a business. Segment operating income down again year over year, up quarter over quarter though, not bad. And we see decrease again in these profit lines, which is not unexpected. Not only did you have Fox acquisition, you also have this new streaming service, which you're having to pay for all this content on. It's not an easy process to consider. Certainly not. So naturally, we see here, so company evaluates performance. Let's see, nothing wild here. Income again. Nothing. I mean, again, nothing significant to stand out here. Nothing significant. That's what I'm saying. Media networks changed 22% year over year, up 13% year over year. Parks and Entertainment up 8%, up 6% year over year, which is fantastic again. Obviously, they opened like Star Wars Land. I mean, you didn't see really growth in revenue for the park segment for quite a while. Studio Entertainment up massive quarter over quarter. And you see another good quarter upcoming with Frozen 2 as well as the new Star Wars movie. Year over year up 11%. Direct to consumer, obviously you can't really judge that necessarily, just because, again, whole new streaming service, it's something to consider. But total revenue is up 17%. Love it, love it, love it. Obviously a massive decrease in direct to consumer. We saw a little bit more profitability in terms of parks and entertainment. Studio also got a little bit of a hit, again, with new and more developing technology. They have to spend more to make better movies. It just makes sense, from my perspective there. Not unexpected. So for media networks, you have cable networks. Again, a Fox acquisition helps us quite a bit. Increased 20% year over year. Broadcasting, 26% year over year growth. Totally up 13%. Not bad. Not bad by any means. Let's see. Decrease of ESPN due to increases in programming, production, and marketing costs. Higher programming cost rates increased by the NFL, college sports, and MLB. Not unexpected. Broadcasting growth. Let's see. So again, these are some neat little things to consider. Sales of merchandise based on Frozen and Toy Story. That's right. Growing their parks, experiences, and products line. Gross Disneyland Resort. Again, more expenses due to the Star Wars Land. Disney World Resorts were comparable to the prior year quarter. Not unexpected, nothing insane. Nothing wild going on here. Again, Studio Entertainment, Aladdin was a big hit. Lion King, Toy Story 4. Previous quarter had Incredibles, Ant-Man and the Wasp. Pretty cool stuff here. Again, we're looking for a decent upcoming quarter in terms of that, so definitely consider that. Direct to consumer here is the real big part of it. Increased operating loss was due to, again, the launch of Disney Plus. Nothing unexpected there. 100% of Hulu's operating results are included in the direct to consumer. Not bad. Not bad. So, again, I mean, as far as that Disney Plus number is concerned, Disney Plus is definitely the key forward to turning this company back into a mega growth company, and that's going to be a big aspect. I mean, I bought into this company two years ago, and it was stagnant, just for the hope of what was for the future. And I'm glad to see what exactly came of it. I certainly appreciate it. I think things are good. Uh, let's see, not bad. Free cash flow again. I just talked about free cash flow and how I love it on Activision. I don't love it on this, but it's in an attempt to increase the business, so I'm not upset by it by any means. So again, conference call info. I did not listen to the conference call. I didn't have time yet, but it's important to consider there. Probably listen to the conference call, and I will when I have time. Unfortunately, too much work lately, but we'll see. That's my Disney analysis. So I hope you enjoyed. It's a very good quarter, and we shall see how the stock goes.